2 weeks ago at the start of the weekly update, I had explained that every year I support a backpack program for kids going back to school from families that otherwise couldn't afford it. We step in and we buy them everything they need to go back to school. And it's that time of year. I had mentioned that for 4 weeks in a row, starting with this week, that every like the video gets, the weekly update gets, I would donate an extra $1 to the backpack program. And every new subscriber that the channel gets as a result of the next 4 videos, because YouTube breaks it down as how many subscribers you get per video, I would also add an extra $1, and that all of the monetization that this video generates would go directly to the program as well. So the goal is to add an extra $6,000 to what we spend this year. So if you click like on this video, and for the next 3 Sundays you click like, and if you're not subscribed, you subscribe while you're watching this video, that's $5 that you can contribute towards this program without spending a penny. If you feel like giving more, this is the website here for Big Brothers Big Sisters of Niagara Falls. And the first one here, to donate to BBBS of Niagara Falls, click here. You'll just click there and you can fill in the amount that you would like to give if you would like to support them directly. Supporting them directly doesn't support our backpack program. That's okay, because it goes to them and then they spend it in their general spending. They can't then send it to an external body like our organization, which then buys the backpacks. They can't do that, but that's okay. So listen, click like, share it with your friends, get them to click like. They don't have to watch the video, they just have to click like. Let's get these likes as high as we possibly can. Let's get new subscribers from this video as high as we can. When you come across the ads, let them play for a little bit. Once you wait 5 seconds and it says a skip ad, it generates no revenue if you click it right away. But if you let it run for about 5 or 10 seconds past that, it starts to generate revenue. Let's see if we can't get that up. And every week I'll report to you how much has been incrementally added to the amount that we're going to do anyways. Our target last year, we hit 30 backpacks. We spent $250 a backpack. That was $7,500. I want to get to a minimum, not a maximum, a minimum of 40 this year, and we're going to raise the price to $300 that we spend on each one. So I want to spend a minimum of $12,000, and you will tell me how much above that $12,000 mark we spend by the likes and the revenue generated. And if you want to reach past all of this and say, well, you know, it doesn't cost me anything to click like, I don't mind donating $5 or $10, here you are. Here's the website. It is the first link in the description box below. Okay, let's start with our rates. Let's see where we've been over the last week. Again, broken down between money market and capital market rates. We can see capital market rates at the long end of the curve have all dropped. Money market rates have all increased. We are inverted now at 20 basis points on the 2 to the 10. The 5 to the 10 is inverted as well. All of the slopes flattened over the course of the week. Look at these. That is huge for the 3-month to the 5-year, the 3-month to the 10-year in 1 week. So we do have inversion happening right now. Some of these rates have hit the highest as well during the week. July 14th and July 13th, all the way out to here, all the way out to the 3-year, have hit the highest levels since the beginning of the year, either the 13th or the 14th. Capital market rates from the 5-year out still hit their highs on June 14th. We're still wondering whether or not the 10-year has put in the highs for the year. It's at 293. The high for the year is 3.49. If you're following the Fed balance sheet for the week from July 6th to July 13th, it increased just $1 million. That could just be a rounding error, right? But it did increase. It didn't decrease. But that's just a function of no maturities during that period of time, so nothing is run off. So we're going to keep our eye on this, and we're going to see if it's decreasing at the rate that it should be decreasing at. So whenever we have an inverted yield curve, and we'll look a little bit more at that in a bit, the question is, because it's always been cited, it is a leading indicator of a recession. It is not a guaranteed predictor. It is a leading indicator. Leading indicators don't necessarily mean that the outcome will happen, but that the probability of it has increased because, the indicator is suggesting that that's the path we're headed on. But you need to see more than one slope invert. You need to see a number of slopes invert. And the probability of recession is a function of the length and the depth of the inversion. So if the inversion lasts for more than 3 months and we breach more than 40 basis points on the depth, there has never not been a recession. Never not been. So those are the two conditions we're looking at. I think for the 2s to the 10s, we're somewhere around 15, 16 days of inversion. The longer it stays inverted, the deeper it gets inverted, the higher this probability gets. Looking at the federal funds futures for the rate in December, it's implying a rate of 3.45% as a terminal rate. And there's some thinking that, well, we're going to be 3.75 to 4%. So it's not being priced in to the market. And we'll look at what's causing that. The CPI report was hotter. It came in higher than expected. However, inflation expectations based on consumer expectations fell on Friday. I don't place a lot of stock in somebody's expectations, because just because you expect something to happen doesn't mean it will. The market is going to be what the market is. It's going to produce what it produces, regardless of what your expectations are. Expectations of higher inflation can actually create higher inflation, but expectations of lower inflation don't actually create lower inflation. Let's look at risky bonds, the OAS, just the spread here. IG and high yield put in the highs on July 5th. IG unchanged for the week at 1.6. High yield 5.5 to 5.53. That should be a drop of 0.07. The math doesn't seem to be working there. I'm reading it wrong. I thought it was 3.43. Through 5.5 to 5.53. It is working, up 3 basis points. I would call that relatively unchanged. So it doesn't look like spreads changed for a portfolio of IG and a portfolio of high yield. Let's look at specifics. AA, BBB, BB, and CCC are lower. 9.2 to 9.1 gave back 1 basis point. 2 to 2.01 added 1 basis point here. Relatively unchanged. If we're wondering why I'm taking the A's and the BBBs, this is near the upper range of investment grade. This is near the lower range of investment grade. Why am I not taking AAA? Because that is a government rating. There is no corporate rating that is AAA. AA is your highest, and those are typically your banks. And there's BBB. There's one rating, I believe, that's lower than BBB, but this is near the bottom of the investment grade. And then with BBs, you're near the upper end of investment grade. 422 versus 1226. This was the highest. All of these are on July 5th. Where are we now? 372 from 422, which was the highest. So we did gain during the week from 358 to 372. And here, 1186 to 1195. These are not really big moves overall, so I don't know that there's anything really exciting that we can look at in the spreads and say, uh-oh, there's a bit of a problem. The most exciting thing going on in rates this week is the front end of the curve and the inversion. This is the most exciting part of it. So looking at the Fed meeting in July, the possibility of 100 basis points is being floated around. The Bank of Canada on Wednesday, an hour and a half after the CPI report was released in the U.S., the Bank of Canada did move 100 basis points. And the Bank of Canada Governor, Tiff Macklem, forecasted, not so much forecasted, but gave his expectation of what he thinks Canadian inflation read will be this week, and he is greater than 8%, which is an increase over the last read, and the last read is what caused him to go 100 basis points. If this comes in higher, Yeah, 100 basis points might be on the table for the next Bank of Canada meeting. So because you've already had one central bank move 100, the possibility of the Fed moving 100 is a real thing, although I'll put it low at 20 basis points. 75 basis points, 80% probability. But what this is saying is that there's a 100% probability of at least 75 basis points. So on the 27th, I would expect 75 is the floor. They're not going 50 or 25. They're going to go 75. Maybe they go a little bit more because retail sales were not bad overall. And if we recall the Fed minutes, they have a singular focus on inflation and they are afraid of inflation getting away from them. So they're not going to stop. They're not going to lighten up. It's 75, or the thinking might be, why not do some shock and awe? Why not put 100? Why not just get it over with? Put it all in right now. We're going to do it anyways. Sooner is better. Maybe they'll lean towards that, but I give it 20% as of now. Next week, depending on what the data looks like throughout the week, if earnings come in great and earnings guidance is really strong and the economic data is really strong, they'll go 100 because the economy can handle it. They'll go 100. So the stronger the economy is right now, the more we're probably going to lean to more aggressive rate hikes, which means the market is not pricing in what a terminal rate in December would look like at 3.45. All right, real yields, break-even rates. Not going to waste a lot of your time here. This is a big unch week over week. There's no story to tell there, kind of in a holding pattern. For real yields, they are all down. From the 5 right through to the 30. Lower real yields are supportive of risky asset prices. So the lower they go, the more supportive. It doesn't mean that the price will go up. It's more supportive of higher prices because the discount rate, the real component of the discount rate is lower. Moving on to housing. Little bit of a glimpse here into the weakening housing market that continues, but to translate that into inflation, if you watch the mid-market Q&A, there was one section in there where I talked about how the OER is determined. I discussed the sample size and how the households were sampled, and we looked at a lag effect that if this is a housing price index. If you take a 16-month lag, you expect the OER will peak, or it has the highest correlation with a housing price index with a lag of 16 months. So 16 months later, the OER peaks. So that becomes very sticky. Let's look at rates. 5.72 on a 30-year fixed. FHA 5.25. Adjustable rates 5.4. All well above 4%. All well above 5%. A 15-year fixed at 4.97, just squeaking in under 5%. But you're amortizing over 15 years instead of 30 years. So these numbers here are based on $100,000 per month. And the 30-year jumbo at 4.8. Mortgage applications for the week ending July 8th down 1.7%. Refis up 2.24. Listen, I don't think that you can read a lot into that. I mean, it can go up 5%, down 5%, meaning that it's barely even changed because it's such a low index level to begin with. It's such a low base that any volume will look like a big percentage at this point. So I think the refis will bounce between positive and negative for a while as it bounces along the bottom. I don't know that you can get much lower than where it is right now. Purchase index down 3.57%. From Realtor.com, let's look at some key metrics here. Median listing prices, new listings, active listings, time on market, and all the changes here are year over year. There's year to date, and then the last 3 weeks. This is the week ending July 9th. If we look at median listing prices, up 15.9% year over year. Let's skip this weekend here, go back to June 25th, 15.7%. Kind of flatlining year over year. This increased to 18.3, but we talked about this last week that this is ahead of the July 4th weekend, usually a very high traffic volume weekend for open houses. So being that you're going to have so much traffic flow, you may as well list at the price you want. And if offers come in, you might get it, but anybody's free to make an offer below what you're asking, but let's just list it at a higher price, see what happens. And I said last week, that after the weekend we should see that come out, and we have. New listings draw year over year is 6% lower than last year, whereas the week before it was up 8%, then 5%. But we are after July 4th right now, and typically once you get past the July 4th weekend, the housing market begins to slow down seasonally anyways, because you enter vacation season. Once you get into August, you're into back to school mode. After Labor Day, it's the big back to work because vacation season is over, and the housing market activity tends to drift all the way down into January, typically mid-January, where it bottoms out, and then it starts to show activity coming up again and peaking in the spring. So this just may be natural seasonal effect here. Active listings up 28% year over year. Last week, the active listings were up 29% year over year. So basically, it's holding its own. It's not increasing year over year. It's holding its own. But this is interesting. The time on the market. Year over year, houses are selling 1 day faster than last year. The week before, they were selling 2 days faster than last year. The week before, they were selling 3 days faster than last year. And if you go back about 5-6 weeks in these updates that I do, you'll see that they were selling 6 and 7 days faster than last year. So this is slowing down. The speed at which they're selling is slowing down, but still, year to date, you're still 8 days faster this year than you were last year. However, this is a full amount over the from January 1st. So you might have a lot of front end speed in this one. This is clearly showing that the pace at which they turn over is slowing down. Maybe next week we'll see they sell at the same speed as last year, and then maybe you'll get into negative numbers. Next week, big week for housing data. National Association of Home Builders, the housing market index, the expectation is 66. It's a diffusion index, so anything over 50 is expansion. It's at 66. That's quite robust. Building permits and housing starts on Tuesday. Building permits, the previous read was down 7%. Housing starts, the previous read was down 14.4%. So we're going to get a bounce off of those. Was that something that was particular to those months? And now that that's cleared up, does it bounce? I don't know. Wednesday, mortgage applications again. You get them every Wednesday. And existing home sales. The previous existing home sales were down 3.4%. So all of this stuff was negative. We'll see what it comes in at this week. And the housing market index sitting at 66. See if it comes in lower than 66. Coming in lower than 66, and all of these three coming in negative. They don't have to come in more negative than what they were the week before. They just have to come in negative again. Would all be consistent with a housing market that's really slowing down. A little later on, we'll talk about China's housing market if you want to see a housing market that is driving full speed towards a cliff. All right, let's look at the CPI report that came out on Wednesday. This is a CPI for all urban consumers. Here is food and energy. So this first category out here, if you take it out and you just pay attention to the bottom categories, that's your core inflation. If you add your food and energy, you get to your headline inflation. Some things to pay attention to here. This is the food category up here. It has zero correlation with the economy. Now, whether the economy is doing good or doing bad, it doesn't really change food prices. It may change the composition of your food basket. During good times, you may put different things in your basket at the grocery store, and during harder times, you may put other things in your basket, but the price of those things are unrelated to the economy in general. For energy, it does have a correlation with the economy. The correlation is greater than zero. However, the elasticity of demand is extremely low, meaning that if energy prices increase by 10%, demand does not drop by 10%. That would be an elasticity of 1. Demand drops by a significantly smaller amount. But the energy sector is correlated with the economy because the more vibrant the economy, well, listen, producing stuff takes energy. The more stuff you produce, the more energy it takes. The more people who are employed, the more people who are driving. The slower your economy, the less stuff you're making, the less energy it takes. So there is some correlation with the economy as far as energy is concerned, but there is no correlation with energy with interest rates. Interest rates are low, interest rates are high, energy use is energy use. When interest rates are very high, you don't really change much of your behavior about how you use energy. If energy prices are high, you may change your behavior to some degree, but remember, the elasticity is very low. There's not much you can do without radically changing behavior. So headline is usually ignored, and you pay attention to core. The Fed is very well aware that, listen, raise interest rates all you want. You're not really going to affect energy. You're not really going to affect food, which is why we see Biden traveling the world trying to get countries to pump more oil, without recognizing, for some reason, I don't know why, that it's refinery capacity, not the amount of oil you pump, but it's refinery capacity that you really should be looking at as opposed to the amount of oil. But I guess his belief is if you flood the market with oil, even if it can't be turned into gas, you would at least lower the price of oil, which lowers the input price to the refinery. But the output, the gasoline, would still be priced based on the demand. All you'd be doing is widening the margins for refineries, of which they're already pretty wide as it is. So I don't know who his economic advisors are, but he's missing the mark on that one altogether. I put some of the weightings in here. Food, 13.423, and I broke it down between food at home and food away from home in terms of inflationary pressure. Energy, 8.665. So as a weighting, it's really not that big. If you look at gasoline, it's 4.82. It has a weighting of 4.82 or 5%. Call it 5% of what you spend is believed to be spent on gasoline. Energy, less food, all items, less food and energy, a weighting of almost 78%. Commodities, less food and energy, 21.249. And then I break it, there's new vehicles, used vehicles, they account for 8% of that. And shelter is the big one, 32.3%. Services, less energy services, 56. Of the 56%, 32 is shelter. Very, very sticky. We've already looked at that last week. If you missed the weekly Q&A from last week's video, you may want to watch it because it does go into detail about the OAR, and we expect the OAR to be sticky. OER, I'm not saying OAR, OER, to be sticky for at least the next year, year and a half. This is interesting up here. If we look at new vehicles, April 2022, they were up 1.1% month over month. Then they went for May, we're only up 1% over April. Then for June, they were only up 0.7% over May. That seems to be going in the right direction. But for used vehicles, hard to make sense of this. A drop of 0.2, another drop of 3.8, another drop 0.4. No, back up 1.8 here, back up 1.6. I don't know what to make of what's going on with used cars and trucks there, but new cars seem to be going in the right direction. But, I mean, if you go back to the beginning of the year, January, 0.3, 0.2, then a big jump to 1.1. So even the 0.7, even though it's coming down over the beginning of the year, still quite significant. Okay, this is an interesting site. This is from the Federal Reserve Bank of Atlanta called the Wage Growth Tracker. And they break wage growth down into a whole bunch of different categories. And you can see all the different categories they have up here. So I've picked a few. The overall, those that are paid hourly, job stayer and job switcher, because I found those two super, super interesting. 6.7% for wage growth. This is a 3-month moving average. 6.7%. For hourly workers, it was up 7.1%, paid hourly, 7.1. So you can see that if you just refer to the managerial sector, the supervisory sector, they're up. Actually, they'd have to be up mathematically. They'd have to be up lower than the 6.7. Paid hourly is about 80% of all workers out there. This is super interesting right here. A job stayer, 6.1. Job switcher, 7.9. JOLTS, the last JOLTS survey. This is job openings. Openings, 11,254,000. It was a drop over April. But look at the quits rate here, 4,270,000. This is a drop of 57. When we look at this quits rate, you have that many people who are quitting because they can find another job rather easily. If you look at what happened during the month of May, 6.5 million people were hired, 5.9 million people were let go. Separations means get out, quit means I'm getting out. So when you have this much going on, you have this many openings, which by the way is almost 2 times, roughly about 1.9, but let's call it 2 times the amount of unemployed people. This is where you're going to get wage inflation that is going to be persistent for a while. You have to break the employment market to stop that from going on, because people are walking like that's a big number, by the way. Over 4 million people are voluntarily walking out the door because they know that they can walk across the street and reprice themselves. 7.9%. Let's go take a look at this. This is interactive and it's really cool. Let's go have a look at it. Okay, here it is. You have a whole bunch of different options at the top. I've got it on the unweighted series hourly, and you can see 6.7%. You can click on wage level, for example, and if you hover over these, the series below gets highlighted, so you can actually see the separation. Or you can move your mouse along here, and inside the box it tells you what they are. First quartile, 7%. That means the bottom 25% are seeing the largest wage gains right now. Look at the fourth quartile. That's the top 25%, only 3.7%. Income inequality being fixed, anyone? Right? Let's look at by gender, because that's always a hot button topic. And let's go right to the very end. Female wage growth right now, 5.5%. Male wage growth, 5.2%. Look by education, and we'll go all the way to the end. The highest wage gain is going to those with high school, 5.9%. Bachelor's degree, 4.9%. So if you're a male in the top 25% of income earners with a bachelor degree, you're not doing too well. But if you're a female with a high school education in the bottom 25%, your wage gains are really big. So this is the market on its own, fixing a lot of income inequality. Well, not fixing, but working its way towards a solution, as opposed to working itself away. Now, with the quits rate over 4 million, with unemployment at 3.6%, at job growth still occurring, the Fed is very comfortable raising inflation. Remember, raising rates. It has 2 mandates, price stability and full employment. The full employment box is checked. It doesn't have to pay attention to that, which means it's free to just pursue inflation. And in the last minutes, when we read the minutes, they were extremely focused on inflation. So raising rates, you have to raise rates to destroy the job market, because you have to destroy the job market to destroy wage inflation, because it's a sticky component of CPI. That in its own will destroy what the market is already doing to fix income inequality. It's kind of a difficult place to be in, isn't it? If we try to kill inflation, we kill this positive thing that's going on. But if we let this positive thing that's going on continue to go on, inflation expectations may come entrenched. What's a policymaker to do? Anyways, you can play around on this. The link is in the description box below. All right, staying on our inflation theme, I've got 2 charts up here from the Federal Reserve Economic Database. One is sticky price, the consumer price index, just for sticky prices. And what this is measuring is that component of inflation which they believe to show persistence. In other words, they are sticky prices, and because they tend to be sticky, they tend to be good forecasters of the next period level of inflation. This is Consumer Price Index headline, and this is core. So we took off less food and energy. Where are we over here? 0.65413. These are all month over month. Notice the frequency here is monthly. It's all month over month. And it's 0.65413 is considered sticky versus the headline month over month, which is 1.3%. This over here is a monthly index, but each month is year over year. This is month over month, and this is year over year. As a percentage change, there it is right there from a year ago, seasonally adjusted. 5.42596 is considered the sticky component versus a core of 5.9. 5.4 versus 5.9. So if we're using this as a predictor of what the next period inflation would be, it is suggesting 5.4 being just the sticky component. So the other parts may move up or they may move down, but we would expect that we would start our estimate from 5.4 and determine whether the non-sticky components would increase or decrease. This is rather interesting. You have a no drop in the sticky price CPI without a recession, and you have no peak without a recession. So here we have it rising, and it only falls after the recession. Here it rises again, and it falls, but we have a recession. Here it rises and falls. We had twin recessions in the early 80s. You have a rise here, the series falls, but it's because you had a recession. I say because you had a recession, because it seems to be a cause and effect to me. You have a rise, but it doesn't fall again until the recession. You have a rise, and it doesn't fall till a recession. You have a rise. There's no saying where it's going to go, but if it follows the pathway, it will not fall without a recession. The other price measure we got last week was the Producer Price Index, the PPI. And I had been asked if we could look at PPI as a potential margin compression for retailers when we compare it with the CPI. So if the PPI is up 12% and the CPI is up 9%, does that mean we have margin contraction? And you can use it that way depending on the type of index you use. If you use the Intermediate Demand Index based on stage of production, you can get some information on that, but not the other indexes. So it might help to understand exactly what's going on in PPI. So I'm going to give you a very high-level view. It is measuring the change in price from the seller's perspective, regardless of who paid. So let's think about how that could be different from CPI. Let's say somebody goes to the emergency room and has some work done and presents their health insurance card, and then they walk out without a bill. Well, it's the health insurance company that has to pay the charge. So that is caught in PPI, but it would not be caught in CPI because the consumer does not spend money on that. That's already covered. Also, no imports are covered in PPI, no government output, no owner's equivalent rent component in PPI either, no taxes, which sometimes you don't have this OAR. So if looking at just the number of PPI to CPI, CPI captures some things that PPI doesn't, so it's not a good throughput. You do have to get a little bit more specific. There are a number of indexes, 3 sets of indexes. We're only going to look at one here, and then we'll go look at the PPI report and see if we can find these particular tables. And once you see the tables, you'll go, okay, I understand those are all different things here. Final demand is the change in price for commodities sold for personal consumption, like when you buy fruit, for capital investment, so a business buys some computers. Well, those computers could be in the CPI as well, because a consumer could buy them, but if a business bought them, well, that's not for personal use. It is for business use, so it would be called capital investment. Sold to governments and sold for export. There are 6 indexes. Final demand, it starts FD, meaning final demand for goods, for trade services. This is the change in price for retailing and wholesaling of merchandise sold to final demand. For transportation and warehousing, and transportation covers both passengers and cargo. Then there's services less trade, transportation, and warehouse. What is this trade thing? It's not the same as trade services up here. This is the change in margins of wholesalers and retailers. You have one for construction and then overall. So you can look at different sectors. You could just look at overall, or you could say, well, I'm only interested in goods, or I'm only interested in services. For intermediate demand, it's a change in price for goods and services and construction products. I shouldn't write over it. And construction products sold as inputs to production. So if you're looking at, well, does PPI translate into CPI down the road? You're going to be on the intermediate demand indexes instead of final demand. There is intermediate by type. There are 6 indices here. We'll look at them shortly. And by stage of production. Number 4 is your final demand. 1 feeds into 2, 2 feeds into 3. So it's, items in number 1 are sold to number 2. Items in number 2 are primarily sold to number 3. Items in stage of production 3 are sold to those in stage of production 4. And 4 is sold into final demand. So you can look at this set of indexes for some hints as to margin compression, and it is broken down as well by the type of industry that it's in. Let's have a look at PPI. Okay, chart 1, the 1 month percent change in selected PPI final demand price indexes, and you can see the black line is your total. The blue dotted line is goods, and here are services down here. Look at the 12-month percent change. This is final demand price indexes. You're up around 18%. And for goods, you're somewhere just below, what line is this here? Just below 9%. Somewhere between 6 and 9, 7.5% for final demand. Let's look at for our indexes here. This is the 12-month percent change in selected final demand price indexes, seasonally adjusted. So here we should see final demand goods, final demand services. Goods should take out food and energy. So there's your total, less food, less energy. And here's your less food and energy. And you got quite a history here. We're looking at the last one down here, the 0.5. Then you have services, total, less trade. Remember, this was change in margins. That's transportation and warehousing, and another category that they eliminate. You'd have to read the notes to figure that one out. And this last column here is change in final demand, less food, energy, and trade. Okay, let's keep going. Which one is this? This is the intermediate demand price indexes. Remember, there's a number of them. You have processed goods for intermediate demand. You have unprocessed goods for intermediate demand. Bunch of stuff here you can look at. And this is intermediate demand for services by commodity type. So services for intermediate demand, trade, transportation, and warehousing, and other. And finally, what do we have here? Intermediate demand by production flow. Here's stage 1, which sells to stage 2, which sells to stage 3, which sells to stage 4, and stage 4 sells to final demand. So these are the prices received by the producers in stage 1, which means they were paid for by the producers in stage 2. So you can read them backwards like that. Stage 4 received these prices, must have paid these prices over here. And if we keep scrolling down, you get to some technical notes. They're worth reading if you want to get a lot more into what these indexes provide. And we should get to some other tables here, and this breaks it down into a lot more detail. Commodity, it tells you exactly what the index here. Here is final demand. This is final demand and intermediate demand grouping, seasonally adjusted. And if you want to know which one is final and which one's intermediate, you just look down the first column. It'll tell you which one it is. A lot of detail. There's intermediate demand here, index 6, and you just keep scrolling down. There's the index 5. It tells you what index it's from, and then we should get the the group code final demand. It keeps going. There's a lot here. I'm not going to go into detail with each one. I'm going to leave that for you. Some of the category numbers here, I'm not sure what they are because I've never really dived that deep into it either. But if you're interested, the link is in the description box. At least now you have a high-level view of what all of those tables are. They're all different indexes, and you can at least read them to some degree. Let's go through a little forecasting exercise. And you can use the same probability tree that I have up. You can change your probabilities, and you may change your outcomes, or you may, even changing your probabilities, you may get to the same outcomes that I have. But I have two scenarios here: real GDP greater than 0% or real GDP less than or equal to 100%, which covers all possibilities that could happen. I put a probability here of 70% and 30% here, and what is supporting the 70% is observations of PMIs from the beginning of the year. They've all been greater than 50, and we have another look at PMIs this Friday coming up. This is a diffusion index, which means anything more than 50 is expansion. So you can think of services and manufacturing expanding, looking like this. Now it's slowing down, right? Here you may have a reading of 60, and you can draw a tangent to that line. Here you might have a reading of 58. Notice that you're still growing, but you're growing at a slower rate. Here you might have a reading of 52. You've gone from 60 to 58 to 52. They're dropping, but they're still growing, meaning that these sectors are still growing, but at a slower rate, while both services and manufacturing since the beginning of the year have been over 50. So we have expansion there. Retail sales were positive. We'll look at that shortly. Employment greater than 0. Every month we look at the jobs report, and jobs are still being created every single month. Unemployment is under 4%. The natural rate of unemployment is about 4%. We're sitting at 3.6%. Very robust jobs market. And wages, as we've already seen, are increasing. Increasing at different rates for different people, but are still increasing. Well, this is all supportive of GDP growth. There have been some that say that we are currently in a recession now. Well, if we are, it is the most non-obvious recession I've ever seen. So I put 70% weighting on real GDP coming in greater than 0 over the next 2 quarters. For inflation, low inflation, I put some probability, even though I think it's 0, but I put a 20%, 80% probability of high inflation. And this 20% is motivated by some observations. Energy prices over the last 30 days have really come down. Some food prices are coming down in the big grains, the corn, wheat, and soy. Hard commodity have come down. All of these are inputs to production. So if these prices are coming down, producers may not need to pass on these higher costs. If you can get costs just to go sideways for a couple of months, you can take out some inflation. Michigan consumer sentiment 5-year inflation expectations came in at 2.8% versus 3.1%. This was on Friday. And current inflation expectations in at 5.2 instead of 5.3, so they are moderating. Now, earlier I said that I don't know so much that this is as powerful as inflation expectations rising, because rising inflation expectations can create the very inflation you were expecting, but falling inflation expectations don't work quite that way. How they work is through wages, is as expectations tend to drop. It's not as if you say, oh, food will be cheaper now. Well, no, food will be what food will be, but you will say, I don't need an 8% wage increase this year to keep up with inflation. Maybe I only need a 6% wage increase. But that is sticky, and it takes a long time to play out. It's got a long lag, probably the same lag as owner's equivalent rent has. So I don't expect that to come out of inflation anytime soon, but I do note that inflation expectations are coming down. So what is the probability of high inflation? Here we use the total probability rule. You have high inflation here and high inflation here, so add the two. There's an 80% probability that you're going to have high inflation. If you have high inflation through this pathway with real GDP greater than 0, rates are going to keep going up, and I think the terminal rate in December will be 4% plus. And we looked at the Fed funds futures for the Fed funds rate, pricing in roughly about 3.5%. So it's not priced in. So it's going to have to price in higher rates. While higher rates are negative for risk asset pricing. If we follow this path towards high inflation, rates are going to go up at a slower pace. So I think the market is pricing in the right terminal rate. So is this the road to salvation for the markets? If we take this route earnings expectations are going to have to come down. And if earnings expectations come down, the multiple has come down, what's going to have to come down? Price is going to have to come down. If we follow this route, rates, these higher rates are not priced in. This is the discount rate, higher discount rate. Prices are going to have to come down. So what's interesting with these exercises is if you can get to the same conclusion no matter which way you go, you've got a conclusion. If this happens, prices are going to come down. If this happens over here, prices are going to come down through the E. Here prices come down through the discount rate. Here prices come down through E. Looks like prices are going down as long as rates are going up because of high inflation. Remember from the Fed minutes, we read the Fed minutes last week. What did we take away from that when we read it? It is the strength of the language that was used to describe their focus, their single-minded focus on inflation. That some members had expressed fear that inflation expectations would become entrenched and it would be much more expensive to solve inflation then than now. That does not sound like a central bank that's going to look at a few data points that are pointing in a somewhat promising direction and say, I think we can relax right now. As long as the economy is strong, they're going. If the economy weakens and you still have high inflation, they're still going, but it's probably priced in. But watch your earnings. Okay, let's bring China into the conversation because a couple of numbers this week caught my attention and I started digging into the numbers a bit more, and I don't know, I think there's something we should keep our eye on here. As far as the last screen, when I left the last screen, I said, whether we have positive or negative real GDP growth, we're going to have high inflation, prices are coming down. That's only because of my belief that the Fed is going to stay very close to its focus on fighting inflation, even though it is becoming more clear that components of inflation are due to supply constraints and not demand, and that many components of inflation, which I've demonstrated over a number of weeks now, are going to be sticky. And the measures we saw from Fred also show a component of stickiness as well. But because they're so singularly focused on inflation, I think they're going to stay at it and continue to raise rates if the economy is strong. If the economy is weak, I don't think they're going to pull back or stop. I think they're still going to raise, but at a slower rate, which is, the rates themselves are going to create the very recession that I think is probably in the cards as it is. China could accelerate that. Let's have a look at what's going on there. The balance of trade and GDP is what drew my attention. So I started thinking about it a little bit more. Balance of trade for June, exports 17.9, nothing surprising there. Here's the shocker, imports 1%. Remember, the final component of GDP is X minus M. Imports minus exports, exports minus imports. So the wider the differential, the greater the benefit it is to GDP. GDP for the second quarter, which includes June, April through June, came in at 0.4% year over year. If you had a more normalized import number, this would have come in negative. And it makes me wonder, was there some sort of concerted effort across China to reduce the amount of imports in June to make the number, to get to 0.4%? Quarter over quarter, it's down 2.6%. They have an annual target of 5.5%. So I look at that differential, I look at this number and I think, is it only positive because of this? And was this an effort to print a positive number, or am I reading too much into this? I get suspicious when I see things that look like this. China is considering an infrastructure spend to hit their annual target. Because of this, in the last 2 quarters, their GDP, their real GDP, has to be in excess of 7% now to meet this 5.5. Not going to get it without government spending. Which, listen, you have to start scratching your head a little bit saying, if the only way that countries are getting GDP growth now is through government spending, isn't it time to start measuring output differently, or start measuring prosperity differently, or start giving up on this idea of ever expanding GDP growth? Because how do governments get GDP growth? They sell debt. And that's what they're thinking of doing, $220 billion infrastructure spend. And every year there's a bond quota of how many bonds, dollar amount of bonds that they can sell. So rather than increase the quota for this year, they're saying, well, let's reach into next year's quota and let's bring them forward and sell them into this year. And that means next year there'll be 220 billion less that you can sell. So they're going to tap into next year's bond quota, which they've never done before, to consider spending the 220. So to take a drastic measure like that, to have this going on with this low number here just sitting above zero, I'm looking at all this and saying, is there somebody in China that's really worried right now? Industrial production at 3.9% in June. Unemployment is 5.5%. Housing price index, I start looking at that, it's down negative 0.5, doesn't seem so bad, but here is the trajectory of housing price inflation. Sorry, not housing price inflation, but the housing price index. Straight down. Every month has been straight down. Not 1 month of recovery. Every month straight down. Retail sales were up 3.1%, but you can see that there is a definite downward trend going on here. Here's your COVID lockdowns. Here's your bounce back. That's it. You stop people from spending for a major part of April, and when they can get back at it, 3.1. That seems rather anemic. China has reaffirmed its commitment to COVID zero, meaning that if it shows up again, they will not hesitate to shut down a whole city again. It's going to show up again. I mean, that you can predict, I think, with 100% certainty. It's going to show up again. Are they going to actually shut down the whole city? Well, there's a greater than 50% probability that they will, because they have reaffirmed that statement, COVID zero, and that's it. So they getting that 7% seems less and less likely. It seems more and more likely that this 0.4 is going to, at some point, be less than zero. And right now, China seems to be the engine of global growth. And I think it was the World Bank or the IMF is encouraging China to spend more money, encouraging the Chinese government to add more stimulus to support the global economy. The other brewing thing going on out there, when I look at something like this, you're naturally drawn to the property developers, because we have heard some issues there with their amount of debt. There is a limit to how much local currency debt they can raise, and when they hit that limit, the property developers tend to raise foreign currency or issue foreign currency debt, because they're not limited there. So they issue debt in foreign currencies. 13 billion of foreign currency bond payments are due in the second half of 2022, and you've already had one default, $1 billion default. I think this was July 3rd this happened. Shimao Group, I hope I'm saying that right. Shimao Group, already defaulted on $1 billion. There's another 13 billion. This is in foreign currency bond payments, not in all bond payments, because there are some local currency bonds, but in foreign currency bond payments, another 13 billion. And I think they have a total of 100 billion across. This is just the property developers. So 13% of that is coming due in the second half of this year, in a property market that seems to be just falling off a cliff. And there was, I think it was the Financial Times had a video up on the property market in China, and they were showing some of the cities and some of the apartment buildings where they're ghost towns, like 40-50% of the buildings are just empty. Or was it 40 to 50% of all the apartments in those cities were just empty. So what had happened was there was this overbuilding, because you had all of these people coming in from rural areas into the cities. Well, you needed a place for them to live, so you had all of this building going on. Well, that migration from the countryside to the cities is pretty near over. It's been going on for almost 20 years now, since China entered the WTO. It's been going on for almost 20 years, and it's pretty much over. And you got all these empty apartment buildings. The unaffordability index in these cities is extraordinary as well. When you look at prices in cities like Beijing, Shanghai, you can't even afford, the average worker couldn't even think of affording an apartment. Well, what's going to happen? This is going to keep going down, and property was a huge driver of Chinese GDP growth, as much as 28%. Compare that with somewhere around 15-16% for something like the US or the UK. Well, if this is going to go away, I don't think you're going to get this, which means you got to build something. You got to build something, so they're going to try to get this done. But this is not a very good direction to go. This is not a very promising thing brewing right here. And to add matters worse, this is foreign currency bond payments. Here is the yuan. In the last 90 days, the yuan has lost 6.26% of its value against the US dollar. Now, it hasn't lost that. The rate is set by the Chinese government. They've decided to weaken the yuan against the US dollar to continue to support their exports. But that makes imports more expensive, and it also makes it far more expensive for the property developers to refinance their foreign currency bonds, because they got to refinance them in foreign currency because they've maxed out what they can do with local currency bonds. So you need more yuan for every single dollar, 6.26% more. So this is, to me, this is a problem that looks like it's brewing, that I don't think markets have really priced in. If you lose China, it's the second largest economy of the world. If you lose it as an engine of growth, you almost cement a global recession. So it would be a nice segue at this point to talk about U.S. dollar strength, because we just talked about the yuan losing almost 6.5% of its value in the last 90 days. Let's look at what the strength of the U.S. dollar is doing versus other emerging market currencies. And here is a list down here of emerging market currencies all the way to July 15, 2022. Year to date in blue and since the election. And on this side is the sovereign risk tracker and the 10 most at-risk countries. Number one is Argentina, which is over here. Well, look down here. The Argentina peso has lost almost 90% of its value since the U.S. election. Since the beginning of the year, 20% of that depreciation has come just from the beginning of the year. This over here, this 57%, means the external debt, or sorry, not the external, the dollar debt as a percentage of its GDP. 57% is denominated in US dollars as a percentage of its GDP. And look at how much it has depreciated. And here is number 10. We're looking for the next problem. There it is. You also have Ghana down here. This is number 2 on the list. Turkish lira has dropped 82% basically since the US election. Another 23% this year. 54% GDP denominated in dollar bonds. So you just have to look at this list and look at, look for the big bars over here. This is the Brazilian real. It has appreciated since the beginning of the year, even though it's down 40% since the U.S. election. It is going in the right direction, but it does have some weighting here. If you look at sovereign risk index going all the way up, the darker it is, the higher it is. This looks like it's somewhere in here, in this region here. This should be no surprise, right? There's Russia, there's Ukraine, here is Egypt, here is Ghana over here. Pakistan is up here, Turkey is over there. So this is kind of interesting stuff. The link for the sovereign risk tracker is in the description box below. I had introduced this, I think, 2 weeks ago on the first Q&A session, that you could drop down this menu over here and you could look at the globe along a bunch of different metrics. This is just the overall risk level, but you could look at it in terms of debt as a percentage of GDP, external debt, dollar debt as a percentage of GDP. So interesting things to look at there. As the US dollar Heck, it's at what, a 20-year high? It's unbelievable, the strength of the US dollar right now. Canada raised its interest rate 100 basis points, and it rallied that day by something like 70 pips, only to lose over 200 pips the very next day and hit multi-year lows. Looking at this thinking, what's a country to do? Almost every analyst I read who's a currency analyst agrees that the US dollar is massively overvalued against what's called a G10, 10 of its largest trading partners, massively overvalued, but that it's not going to give back until we start to see some easing in the central bank, or some idea that the central bank is saying, okay, we're going to start to slow down a bit. But when it does correct, it's going to correct. The problem that a lot of currency investors are having right now is, when do I step in? Because this thing is on a tear. A 20-year high just doesn't stop overnight. And if China gets worse, and if the globe gets worse, and these emerging markets get worse, well, more money flows out of emerging markets, which pushes down their currency even more. It's not going to the euro. Euro has hit parity, and the thinking is it's going to go right past parity. The lowest I've seen is 85 cents, and if it does that, US dollar's not backing off. The lower the euro goes, the stronger the US is going to go, because there's no other currency that can handle the size of the flows that are coming out of the euro. The higher that goes, the more dangerous it gets for these emerging markets. And all it takes is one to start that domino effect. Okay, let's bring it back to the US data. Let's look at retail sales, because this seemed to be a positive on Friday, and I think it is. There was some revisionist thinking during the day that, while it didn't beat inflation on an inflation-adjusted basis, it was flat to negative. And you can't compare retail sales with CPI, and I'll show you why. Let's try to get it on an equivalent basis. So we'll take retail sales, we'll take out gasoline, we'll take out food, and see what we get to. So retail sales, this is June 22 versus June 21. This is a year over year. This is May 22, so it's month over month. Retail sales ex gasoline, 5.13 year over year, 0.7 month over month. Let's take out food at grocery stores. You get 4.73% year over year. You get 0.724 month over month. With core CPI takes out energy and food. This just took out gas. It's hard to strip out all the energy. Just took out gas. 5.9% versus 0.7. So this seems comparable. And this here is like, oh, well, real quantity must be less than zero because it doesn't meet the price increase. This is not comparable. I've heard this on Friday, comparing retail sales with CPI and saying, well, on an inflation-adjusted basis, they're negative. You can't compare it. Retail sales has no rent component. CPI does. It has no OER, owner's equivalent rent. It has no healthcare services or insurance. But that's all in CPI. This came in 0.8, 0.7, 0.7, 1.9 month over month. Well, core CPI was 0.7. All of these are either 0.7 or higher. So it actually would be lower. So this actually comes in stronger, implying that there is some real quantity increase in that as well. If I remove auto dealers, because new cars were up 0.7, used cars were up 1.6 year over year, it was 11.4 and 7.1. If I remove them, it's up 5.8% year over year, and this is now up 1.23% year over year. And if you remove all of these from the month over month, because they're all 0.7 or greater, this can only go down. 1.23 month over month versus something lower than 0.7 starts to become more comparable. Well, that is real quantity greater than zero. Same over here. If you strip down the 5.9 for these months, this is 11.4, 7.1, all greater than 5.9. Same with these year over year. They were in around 5.6. I think OER was 5.6, rent was higher, healthcare services were higher, insurance was higher. This would only come down. You're at 5.8%. Oh, sorry, you're also taking out new and used cars to try to get to something comparable. So real quantity, I'll just put RQ, real quantity is greater than 0. When real quantity is less than 0, well then yeah, that leads itself to thinking that that lends itself to real GDP being less than 0. But these are not comparable numbers. You cannot just take retail sales, say, well, it increased by 8%, but headline inflation was 9.1, hence real quantity is lower. Well, you can't say that because there are components in CPI that are not in retail sales. You have to try to get as close as you can. The best way to do it is to continue to keep going and actually take out the indexes, and that would require some spreadsheet work and probably about 3 or 4 hours to get to a better number if I was so motivated to be exactly precise on it. But I can see in the direction that I'm doing right now that quantity, real quantity, is greater than 0 month over month most definitely, and probably year over year, though not really great, but probably year over year, but month over month most definitely. So if you go to the retail sales report, table 1 breaks it down to a bunch of high-level categories for you. If you keep going, you get a whole bunch of other interesting tables if you're so interested. So here is the numbers that I used over here in this row. If you look for total ex-gasoline stations, these are the numbers that I used over here. You can also take out new car dealers, which are, other auto and other motor vehicle dealers, which I've taken out here. This is interesting here. Electronics and appliance stores. Look at June, 7,703. Over here, look at June over the last year, 8,467. That is a significant drop. It's like a 9 or 10% drop year over year in electronics and appliance stores. If you're interested in this, there's a bunch of interesting stuff here. If you look at gasoline stations over here, you get 69,870. If you move up here and you take the top number, 680,591, minus gasolines, you should get to this number here, 610,721. So it's broken out for you down here. So let's look at it year over year. 69,870. The year before was 46,862. Look at that jump. From May to June, we went from 67 up to 69. So we'll see what happens next month when we look at July over June, because gasoline prices did drop. From June over July, we should see a negative price increase in the CPI for gasoline. We should see a lower amount over here. And if there's a lower amount over here, what's it going to mean? Because most people spend every penny they make, it means it's going to boost some other categories up here. So lower gas prices going forward might be bullish for headline CPI, but it's also bullish for retail sales, because if I'm not spending it at the pump, I'm going to spend it somewhere else. Okay, let's move on to the SPY. On the screen is a 6-month chart. Look at that clear downward sloping resistance line that we have at 39.20. Index is sitting at 38.63 right now, so it's about 60 points up from where it closed. You have a continuation pattern over here. This is a consolidation phase. It's called continuation because it is expected to continue in the same direction in which it was formed, unless you have some break of this particular pattern to the upside. Forward earnings 239.38. So our forward multiple is 16.13. That's forward 4 quarters. And considering where the index level is right now, you have 72 names reporting this coming week. And it is going to be absolutely critical. Guidance is going to be huge, and current period margins, and if any companies give guidance on margins as well. But guidance is going to be everything. I think that earnings for the quarter will be okay because the economic indicators were all okay. Inflation was fairly high, but inflation is a result of rising prices, and who are the companies that are raising their prices, right? So I think that their EPS will be okay. I think a decent number of companies will beat the lower guidance or the lower expectations that might be in place, but it's all going to be about guidance. So let's see who is reporting next week. Okay, so only 35 companies have reported so far, but for the week from the 8th to the 15th, you can see that the earnings forecast has come down a little bit, but still, it's only 35 out of the 500 and some that have to report. There are 72 that are reporting this week coming up. So if we scroll down, once you get to page, I think it's 9 here. Yeah, page 10, sorry. This is where you'll find all the forward 4-quarter EPS, 239.98. Let's keep going and see who's reporting. This is Monday, and you can see when they're reporting. Most are before the bell. One is after the bell, which is IBM. Continuing on with the financials, Bank of America, Goldman Sachs, two big ones to start the week. So that might set the tone for Monday's trading, because there's not a lot of economic data on Monday. There's no Fed speak on Monday. There's a Fed speak on Tuesday. It'll be a lot of discussion during the day of, bear market rally. Oh, the bottom is in. Oh, inflation is going to be higher. No, it's going to be a lot of that stuff going on. So you might even have a bunch of choppy sideways movement. If this comes in bad, well, then I think there's only one direction you go. And then IBM is after the bell. What do we got the next day? We got Netflix and Tesla this week. For those that like the big headline companies, not so much the systemically important companies, but the ones that got big headlines and everybody watches. Oil services are big this week too. Here's Halliburton here. Johnson & Johnson, Lockheed Martin. You got a few more banks in here. Netflix after the bell on Tuesday. Make sure the band is set up and ready to go. That's going to be quite interesting. Estimate is 295. A year ago was 297. So no growth. In fact, kind of little negative growth. But it'll be about their guidance. They are introducing an ad-supported model. Microsoft in partnership with Microsoft. So their guidance might be good based on that and what they think. I mean, they haven't had any results for it yet, so any guidance on it is nothing but just, here's our fantasy projections for it. But it might be enough to support an upswing on this one. Let's go to the next one here. Let's see, a lot before the bell, right up to here. What do we got at the top? Baker Hughes, another oil services company. Getting down to the bottom here, Las Vegas Sands. There's Tesla, Wednesday. So you're going to have a Tuesday party and you're going to have a Wednesday night party. Let's see what happens there. Don't anticipate that it's going to be it's going to be a down quarter. I don't know that it's going to be a total wipeout, but they've got a currency hit, they've got a Bitcoin hit, they've got a China hit based on the lockdown. But they apparently had a really good June in terms of production numbers. So their guidance is going to be everything. I don't anticipate that they're going to guide anywhere light. I think they're going to guide to the absolute high end that they can. That's, my thinking on this one is you're coming out of a bad quarter. All you have is guidance. No one can prove your guidance for another 3 months. So you may as well guide for the sky. And I think they'll guide for the sky. And I think analysts will look past the quarter because the quarter was the quarter. And we'll see what happens there. But, I think they'll probably get a pop on their guidance. Next, we go into Thursday. Anything interesting you see here? Freeport, I'll be watching that one. Some more banks in here as well. Some more after the close as well. Let's keep going down here. And Schlumberger, another oil services company. Twitter. Is anyone even watching that one anymore? American Express, that'll be important. Expected to be down year over year. That's in the morning. Depending on the guidance, and it's not just one or two companies, it's the the guidance overall, the average guidance of everyone. There's a home builder up here, D.H. Horton. I haven't looked at all of them. I sort of just look at the calendar the day before and I determine which ones I'm interested in watching or which ones might have some informational value. And I do sit in on the conference calls on some of them. I sat in on J.P. Morgan's. I don't know if anyone else sat in on J.P. Morgan's, but Jamie Dimon was taking no prisoners. He is not happy with the Fed. He is not happy with the bank ratios, the capital ratios. He's not happy at all, and he was taking no prisoners. He came out swinging. So if anyone else listened to that conference call, or if you haven't, have a listen to it, but he came out swinging. Okay, let's look at the week ahead economically. Well, this week is a lot of data in the U.S. on the housing market. Let's get rid of that thing. It likes to pop up every single time. You would think that having been to this site so many times that it would say, oh, this guy again. There's no point in sticking that thing up. He's aware of it. Building permits, housing starts. You got some Fed speak over here. I think that's the only Fed speak you have because they're meeting the week after, and I think there's a blackout period 1 week before the meeting. This is a big one for Canada, the core inflation rate and the inflation rate year over year. The Bank of Canada governor is expecting it to be greater than 8%. The previous was 7.7, and that caused a 100 basis point increase. Anything over 8%, yeah, you could be following another 75 to 100 basis points at the next meeting. Let's see if it can finally lift the Canadian. Something. Give me something, anything. But we'll see what happens there. Existing home sales in the U.S. Keep going here. New housing prices for Canada. Nothing really exciting. Philly Fed, man, I don't know that the regional manufacturing indexes do very much because you have on Friday down here you have the PMIs. You have the services and the manufacturing PMI on Friday. And I expect them to be over 50. And again, they're diffusion indexes, so anything over 50 is still growth. If we take a look at one, let's look at manufacturing PMI. Yeah, it's come down. It's coming down. But again, anything over 50 is still growth. This is January, February, March. It was climbing into the year, and then it's really come down. You get under 50 on any of these, that's contraction. That's bad. So we'll see what happens on Friday. Beyond that, there's not much to talk about because there really is only a couple of stories going on in the market right now. The big one is inflation. The second one is earnings, especially heavy with guidance. And those sounds of thunder you hear off in the distance, those are emerging markets. Let's see if that storm gets closer. That's it.